Good afternoon, everybody, and thank you for joining. My name is Jordan Darr. I am the Director of Overlay Management here at Adhesion Wealth, and I'm going to be leading our discussion today on the importance of tax overlay. So you've probably seen a lot of articles recently, especially at the end of last year, about the need for tax management. So our goal here today is to clear up a lot of what's being put out in the marketplace and provide you as advisors with some best practices. And so to meet these objectives, in this presentation, we will be discussing why tax management matters to you and to your clients, the strategies that are available in the marketplace that you can utilize to lower your client's tax burden, thereby increasing the value of your advice, and how you can get started reducing a client's tax burden in their accounts today. But first, we need to discuss the basics of tax overlay management. And what that actually is that tax overlay management services are designed to deliver your clients a tax efficient solution while potentially increasing their after-tax returns. They effectively minimize the client's tax liability while continuing to manage the portfolio risk. Now, this is an important and understated component of the overall value that you as an advisor bring to your clients. And we at Adhesion, we call this your advisor alpha. Now, how are we doing this? Well, we identify the most tax advantageous ways to enact trading, both quickly and efficiency at the sleeve and the account level, and we do this on a year-round basis. Adhesion's technology and support system can easily help you as an advisor build tax advantage portfolios, maximize tax savings, and clearly demonstrate your added value through tax planning, risk profiling, and progress reporting on a client's accounts. And we're going to take a deeper dive into these services and how they work shortly. But what's really important, we're going to spend the next few slides talking about, is why tax management matters. And first, I want to quickly define the highlighted words here, tax alpha. The tax alpha is the value that is added to a portfolio by optimizing tax management strategies where the net dollars saved are expressed as a percentage of a client's portfolio valuation. And in other words, how much are you directly increasing a client's after-tax return by? Now, generating this tax alpha can be one of the most compelling and effective ways to show your worth as an advisor. You're helping clients reduce their tax burden year after year after year. Now, finally, who is going to really benefit this? And what we found is nearly everybody who has non-qualified accounts can benefit from this. Who doesn't like paying less taxes? But particular attention should be focused on high net worth clients who are sensitive to sensitive to taxes. These are probably going to be your clients that you already have important relationships with. So these are your key clients to begin with. We also want to point out that the industry adoption of tax management services is hovering right around 10%. We at Adhesion feel that this is a very low number, and we attribute this low number to a lack of understanding of these valuable services that are out there in the marketplace. So now that we've laid the groundwork for tax management, I want to take a step back and really unpack the why tax management matters on the next slide. So there's a lot of numbers here that we're going to get to, but I first want to point out and share a study from Siam and Zhang from the University of Texas at Austin. What they actually found was between 1990 and 2012, investors in stock funds that had taxable accounts gave up 1.12% on their average annual return to taxes. And what that says is that their earnings, a large chunk of that is going paid out to the government in taxes. Additionally, since the market low point in 2009, the S&P has soared over 150%. While on top of that, long-term gains rates have risen from 15% to just under 24%, and short-term gains rates, they've soared from 35% to over 43% for top taxpayers. So what all of this tells us is that historically, clients have given up a lot of their gains in the form of taxes, and additionally, we are in an environment now with large gains and soaring tax rates. And all of these factors combined have brought us to an era today when after-tax returns count more than they ever have before. And to highlight this, I want to share the example on this slide. These are showing actual data from actual clients that are enrolled in tax services here at Adhesion. So the average account size at Adhesion is about $835,000. That puts these clients roughly in a 37% tax bracket. Now, we at Adhesion for these clients have provided a cumulative tax alpha of 3.24% over the last 4 years. That equates to over 80 basis points on average per year. So the average tax liability of $23,000 for the Adhesion client, these Adhesion clients, has been effectively reduced by $6,000 for clients. This $6,000 in after-tax return represents not only tax alpha, but the advisor alpha that we mentioned previously. These advisors, they're providing this advisor and tax alpha to their clients through these tax management services. So now that we've unpacked the why, what can we do to maximize this tax alpha that we just described? And here on this slide, we're showing the main levers that generate tax alpha. We have the product selection of an account, enabling thoughtful tax transaction programs, tax harvesting year-round to realize losses and use that to offset gains, and then always using tax-efficient trading for daily rebalancing. We'll dive into detail on the bottom 2 bullet points, but the first 2 I want to talk about on this slide. The first point being, with the second bullet point here, is that tax transition programs should always be used with bringing on new assets or transitioning into new managers or funds. We should always be looking at the positions that are going to be sold and moving those into accounts in a thoughtful manner so that the client isn't realizing a massive amount of gains in one point. Additionally, I want to focus on here is the often overlooked piece of product selection. This is really the first lever that you as an advisor has to pull in generating this tax alpha. The first point is that we should be using unified managed accounts, or UMAs. You see, a UMA consolidates an investor's various accounts, traditionally a mix of funds, separately managed accounts, each with multiple, often overlapping holdings with various purchase prices and so forth. And in these UMA accounts, there's an overlay manager, such as Adhesion, who oversees all the activity in the entire portfolio through a tax management lens. Since the overlay portfolio manager has this global view, they have the added ability to manipulate individual portfolio holdings to minimize an account's tax consequences. And this is all done while aligning the accounts closer to the client goals. My next point here is that mutual funds are not tax efficient vehicles. You see, in addition to a client trading these positions over the course of the year and them generating realized gains or losses, as most of you are aware, there's an underlying portfolio manager in these mutual funds who has additionally been trading the fund, the underlying holdings of the fund, throughout the course of the year. And those managers are not about to keep those gains and realize the tax consequences. So those are actually passed on to the client in the form of capital gains payments. What we found a lot of times, these capital gains payments, those are 10% of the fund's NAV. They're usually paid out around the end of the year. So imagine you have a new client who just buys into a mutual fund in November or December, and a week later they get a capital gains payment. Initially it looks great until they realize that next April they have to pay the taxes on a year's worth of trading from that fund company. Lastly, I wanted to bring up that we should be using, wherever possible, direct or personal indexes instead of ETFs. Now, what a direct index is, if you think of an ETF, typically and historically it maps out the performance and the holdings of an underlying index. A direct index takes that same index and it actually purchases a representation of the underlying holdings as well. So what you wind up with the example of the S&P 500, you could purchase an ETF that maps out and hold a single security, or you could purchase a direct index and buy the actual holdings with the weights of the S&P 500 itself. The advantages here are, one, you get the performance of the S&P 500, the similarly that you would as with an ETF, but you get to hold the actual underlying securities, and you get to enable the tax strategies that we're going to go through in just a few moments that will increase your tax alpha and your advisor alpha by holding those direct positions. Now, additionally, I want to dive into personal indexes and clarify what these are. A personal index is essentially a direct index like the S&P 500 where you are holding the underlying positions and applying a slant or a tilt towards anything that you as the advisor would like to customize this index towards. So imagine starting with the S&P 500, buying the underlying holdings of that but then putting an ESG screen on it so that you're only using carbon friendly or carbon leading companies from the S&P 500. You're still going to map out the performance of it, and now you've created a fully customizable index that you as an advisor can offer to only your clients. So that's a description of how the two products work and what they actually are. But how do we know that direct and personal indexes are actually better? Well, we're going to take a look now. It's actual client data that's going to show us how it's better. So on this product, we've got a couple of colors and bars here. The gray bar shows exactly why every non-qualified account should utilize tax management services. Clients utilizing just tax management services average over 81 basis points a year in tax alpha. This is a direct and measurable benefit to these non-qualified accounts that is being provided by their advisors. But when we introduce the direct or personal index, the effect is compounded as seen in the red bars of this chart. You can clearly see in this comparison that we're able to generate even higher tax alpha by using these direct or personal indexes. Accounts combining tax management services with direct or personal indexes are averaging just under 100 basis points per year in tax alpha. So the takeaway here is that product selection is an often overlooked piece of tax management. And when building portfolios for non-qualified accounts, we should always be cognizant of the tax impact of the products that we're adding and look for ways to improve after-tax return while aligning our accounts with client goals. So our next distinct tax management lever, and by far the most popular service we have at our disposal, is tax loss harvesting. Now, tax loss harvesting is where an overlay manager goes into an account and they specifically look for positions that have losses and liquidate those positions. Those proceeds are then held outside of those securities for up to 30 days due to the wash sale rule. The wash sale rule states that any position that is sold cannot be purchased within 30 days of that sale. So for example, if we had bought a position 2 weeks ago and today's at a loss, we could not sell that position without violating the wash sale rule. Conversely, if a position was sold 2 weeks ago at a loss, we have to wait 30 days before we can buy that back in. What we do at Adhesion is with those proceeds to ensure that clients maintain exposure to specific asset classes is we will take the proceeds from each of those tax harvests and we will buy a proxy security in that asset class to ensure that they're maintaining their risk profile. So as this relates to a UMA account, we have third-party managers working to generate their alpha and outperform the market, but at the same time, we have an overlay manager like Adhesion, aggressively tax harvesting losses to offset any gains generated through the daily trading. Additionally, we have an overlay manager that will invest those proceeds from the sales in proxy securities during the wash sale period, as we just mentioned, so that the client's assets are not invested in cash for 30 days. Now, this is a really powerful tool, but the flaw that we see in practice is how tax harvesting is utilized. Now, we mentioned we shouldn't just be looking at tax harvesting at the end of the year, and that's what advisors tend to do. And this limits the tax loss opportunities to the current market conditions at that point in time, whereas year-round tax harvesting programs, they capture all of the market conditions and maximize the tax harvesting opportunities. So let's take a look at an example of that. So on this next chart, we're looking at the S&P 500 as a portfolio and mapping out the returns for the last 4 years. Now, if we were only doing year-end tax harvesting, we would have tax harvested an account right here at this arrow. And if you look at the chart, there's a lot of other opportunities out there. Year-round tax harvesting impact is much more profound, especially during the volatile markets. Now, as an example, in 2020, we would have, about a year ago, gone through the market dip that we saw. If we were only tax harvesting at year end, we probably wouldn't have harvested the accounts at that point. And then, so those accounts wouldn't have tax harvested, and then they would have ridden the market back up, and they'd be sitting at all-time highs with probably a lot of gains that they then have to pay taxes for. These circles show the points where we would have tax harvested accounts if we were doing year-round tax harvesting. So all of these points, we would have captured the downtrend in the market a year ago. Clients would have rebounded with the market. They'd be sitting at all-time highs with a significant amount of losses to offset any gains. So what we found is that clients who are using year-round tax harvesting over the last 4 years generated about 6 times more losses than those who are just using year-end tax harvesting. So this obviously tells us we should always be using year-round tax harvesting, and we should not be looking to solve tax problems just at the end of the year. So the last tax alpha lever that we have to pull today is tax-aware rebalancing services. What this is the minimization of the tax impact of daily trades. And when we say daily trades, we mean withdrawals, adjustments to the portfolio, manager trades, anything that a manager or overlay portfolio manager would be trading the account for on a daily basis. Now, the global view of this overlay manager really shines again here because they have that tax management lens we talked about to view all cost basis and all trades in the account. So the levers they have to pull on daily trades, the first one is going to be selecting the most beneficial tax lot to reduce the realized gain. Now, what this means is often with positions, when we go to sell, we'll find that there are multiple tax lots that make up that individual position. So to use an Apple example that we'll come back to multiple times on this slide, if we're selling Apple, what the overlay manager will do is it'll look for the most tax advantageous tax lot to sell. So it will sell short-term losses, then long-term losses, and try to preserve selling gains for as long as it can. Another strategy the manager has of this is if a position is held in multiple sleeves across 2 different managers in the account. So if 2 managers are holding Apple and one manager wants to sell Apple, and the other manager's cost basis is more preferential for the client, the overlay manager can swap those 2 lots so that the first manager can sell Apple, the second manager maintains the position in Apple they want, and the client does both of those while receiving the tax or the preferential tax treatment of selling those better lots. Another tool we just talked about tax harvesting was, and that goes with that though, is the avoid wash sale violations. So the manager knows what's going on in the account across multiple managers. So they have the ability to defer trades, both buys and sells that would otherwise violate the wash sale rule. So for example, if one sleeve was tax harvested and then the following week, another manager wants to buy a position that was just harvested, that overlay manager has the capability to override that purchase and hold off until the wash sale rule is no longer in effect. The last tool is deferring positions until they convert from short-term gains to long-term gains. Again, the overlay manager, they see the cost basis. They're using this tax management lens. So when they see that a position is within a certain time period of becoming a long-term gain, they can make the call to hold off on placing that sell for the client's benefit on their taxes in the following year. Typically at Adhesion, we wait a week, but it could be up longer depending upon the impact of that. So to wrap things up, I want to share the main takeaways from this discussion. The main purpose, as we mentioned a few times, is for an overlay manager to identify the most tax advantageous way to carry out trading instructions. As we discussed, the main ways in which the overlay manager achieves this is thoughtful product selection, active year-round tax harvesting, and tax-efficient trading for their daily trades. These methods have proven and a tangible impact on clients' goals, as we saw through the examples of live Adhesion accounts, to impact a client's after-tax return. So we at Adhesion highly recommend these services be utilized in all of your taxable accounts. And lastly, I would like to share the next steps. If any of you have any questions for existing clients, you can reach out to your dedicated account manager. For external clients, I'm posting contact information so that you can reach out to them as well. These groups will be happy to answer any questions that you have and connect you with the appropriate groups here at Adhesion if you need to have an in-depth discussion. So at this point, I want to thank everybody for attending today, and we look forward to working with all of you on your tax management strategies in the future. Thank you and have a great afternoon.